In the corporate world, doing business with people you know is standard practice. A founder might contract a supply run through a subsidiary, or a CEO might lease office space from a board member's firm. These arrangements often provide a clear business case. Contracting with a known entity bypasses administrative delays, leverages established trust, and reduces expenses through shared resources. However, this same convenience creates a structural vulnerability. The mechanisms used for efficiency are the exact tools often employed for financial obfuscation and market manipulation. When executives sit on both sides of a negotiation, they hold total control over the terms. Without rigorous transparency, these relationships allow insiders to bypass the standard governance meant to protect external investors. This creates a dual reality in corporate architecture. On one side, we find synergy. A parent company shares an administrative hub with labeled subsidiaries, lowering costs for the entire group. On the other side, we find subterfuge. Capital moves through unnamed offshore nodes, looping until the original source and destination are impossible to trace. Transparency acts as the single boundary between a synergistic corporate ecosystem and a vehicle for asset stripping. Because of this, analyzing these transactions provides a clear window into how a company actually handles its capital, revealing whether it serves its shareholders or its insiders. To understand the risks, we have to look at how insiders utilize these opaque networks. Income is systematically shifted from the main business to a related entity in lower tax jurisdiction, draining capital from the primary balance sheet. Asset stripping involves moving high-value physical assets, like factories or property, to a promoter's private firm at a fraction of their true market value. On a balance sheet, these transactions often appear legally permissible, which allows them to bypass standard audits while still causing significant damage. These methods work together to move wealth away from public shareholders and consolidate it into private hands. Identifying these maneuvers requires looking past the paperwork to uncover who truly benefits from the movement of capital. We can see this in the case of Finotex Chemical Limited and its dealings with a promoter-linked entity, Sanjay Exports. Finotex sold goods worth approximately 6 crore rupees to Sanjay Exports. This single related party accounted for 17% of their sales in 2012 and 14% in 2013. A concentration this heavy raises a vital question for any analyst. Does this transaction reflect genuine market demand, or is it a case of artificial revenue inflation? Relying on a promoter-owned entity for a double-digit percentage of sales suggests that the business may struggle to find external buyers. Intra-group sales can mask a company's true health by creating a revenue stream that doesn't exist in the open market. Without arm's-length pricing, internal transactions create a paper illusion of growth, while the underlying business remains stagnant. Beyond revenue inflation, the Finotex ecosystem reveals another red flag: unverified asset purchases. The company purchased a car worth 41 lakh rupees from Sanjay Exports. This raises a clear governance question. Was this vehicle used for a legitimate business, and was the price consistent with the market? Finotex provided no disclosure on the car's actual usage. This makes it impossible for investors to distinguish a business expense from insider favoritism. This risk of disguised loans extends to Finotex's dealings with another entity, Proton Biochem, where rent and service income were reported without sufficient transparency. The most extreme form of this risk is loan forgiveness. Capital moves from a parent to a related party, but the requirement to pay it back simply dissolves. This dissolution acts as an undisclosed benefit, a shift in liabilities that makes the company's financial position appear stronger than it actually is. Corporate loan forgiveness is an unusual practice that immediately triggers regulatory scrutiny regarding financial manipulation. Undisclosed assets and forgiven loans function as silent off-book transfers of wealth. Executing these transfers on a systemic scale requires a specific type of corporate architecture designed for obfuscation. Bad actors often use shell companies, entities with no operations, to hide true ownership and facilitate illicit financial flows. These networks are layered rapidly, forming a complex wall of dummy corporations intended to exhaust auditors and analysts. We saw this strategy in the case of Yes Bank and the Kapoor family. The family allegedly bypassed the bank's standard approval processes for specific property deals. They used complex subsidiary networks to create distance between the bank's capital and the ultimate beneficiaries, violating codes of conduct in the process. When a corporate structure becomes too convoluted for analysts to trace fund movements, the complexity functions as a primary indicator of governance failure. Recognizing these mechanisms allows us to move toward a toolkit for detecting them. A proper forensic screen requires checking both the qualitative intent and the quantitative scale of these deals. Precise qualitative screening begins by verifying if transactions align with market rates, have a clear business purpose, and feature fully disclosed loan terms. From there, we apply rigid quantitative thresholds. We track related party transactions as a percentage of total revenue or assets, setting a limit at 20%. Any volume of insider dealing that crosses this 20% threshold requires deeper scrutiny to ensure profits aren't being artificially inflated. We also monitor intragroup sales. If more than 20% of a company's revenue is internal without clear pricing benchmarks, the quality of its earnings is compromised. Finally, we check the loans. If credit extended to promoters or related entities exceeds 5% of a company's net worth, a forensic audit of the interest and collateral is necessary. Enforcing these limits prevents the artificial inflation of profits and exposes weak cash flows hidden behind related party activity. For the company, failing to disclose these transactions leads to regulatory penalties, a damaged reputation, and a loss of investor confidence. Demanding transparency in these dealings creates a structural safeguard, preserving the integrity of the market and the value of every individual share.